How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world, Options Trading Academy. So if you can hear me, let me know by putting it in the chat that you're actually getting my audio. Make sure that the audio is going through. Let me put something in the stream real quick. And we're going to go ahead and take it from there. Putting that message up. Okay, so we're good to go on that end. So let me know that you can hear me. And so what we're going to do is do our options Q&A. So any questions that you have about options, maybe about particular plays that you're in, let me know. And what we're going to kind of start off with as we, just start putting questions in the queue, and I'll scroll through them and get them. We're going to also talk about this Avis play. Stock ticker is going to be CAR, to try to get people to kind of understand it, because I think if people look at this play the wrong way, it can end up being dangerous to them. They don't kind of understand from a comprehensive standpoint, because there's a lot of people trying to take this particular play and use it to try to promote their particular message. And that's understandable. That's how media works. But it can put you in a dangerous situation if you don't kind of understand comprehensively how this particular situation works. So first, before we get into it and why everybody puts their questions together, this show is being sponsored by www.thehighestpaid.online, and that's an options academy that we created. And it's to really solve the problems of three different people in society, right? That they know that they have this particular problem. First person is a person that doesn't believe they're bringing in enough money. They're dissatisfied with the amount of money they make from their 9 to 5. The second person is going to be somebody that doesn't like the fact that they got to take away a lot of time, transit, the amount of time that they got to spend at work just to make the money that they're making. And the third person is someone who doesn't like the fact that there's a cap on their income. So they don't like the fact that at the beginning of the year, they know exactly how much money they're going to make, regardless of how much work they actually produce or how productive they are in their job. And what we figured out how to do is solve that problem by leveraging the options market. And the options market is an environment to where you can pretty much make as much money as you desire. There is no cap on your income, and you can work from home. You can still be around your family. And it doesn't really take all of your day. So we call it the highest paid part-time job in the world, is because you can sometimes 2 to 3 days a week, or sometimes 3 days a week, maybe working 3 to 4 hours a week, make as much money as you will be making working over a 30-day period. And once you start to understand the power of the markets and what they can do for you, it opens your eyes up to a lot of new possibilities from a personal standpoint, but also starts to open your eyes up for a new direction for your family. But this particular offer is centered at people that understand that this is a problem. We understand many people don't believe that the amount of money they make is a problem. They don't want to be around their family. They want to spend time outside of the house. So we don't necessarily have a solution for them. But as we're getting ready to go into these holidays, we're getting ready to go into the top of the year, I would encourage you to start looking at, if you desire to change your life, what are going to be the things that are going to create more leverage for you and allow you to live the life that you really desire, and not just be a laborer for somebody else to help them get the life that they actually desire. I also want to tell you that if you get value from the content, you want to hit me up through my Cash App. It's at davidweswill. No donation is too small, because what we don't do is make people pay before they come into the door. And we don't a lot of times pass the offering plate around like we're in church. So if you think that, what I'm giving you is allowing you to live a better life, and you want to kind of give something back, I would appreciate the Cash App. But most importantly, what I want to try to do is get you to do business with us, because we believe we can solve your particular problem. Now, what we're going to roll into really quickly as the questions start to roll up, and Floyd Wilson, I appreciate it, man. Appreciate the, what do you call it, the super chat. We're going to kind of talk about this Avis play and kind of why I went parabolic, I want to say Tuesday morning. And, this is a ticker I have been looking at for a very, very long time, because I believe that the price point exceeded the value of the particular company. This company is between 13 and 15 billion dollars in debt. They're in a particular environment in which there's not a lot of margin. The car business, from a manufacturing business, but also from a rental business, there's not a lot of margin in the business. So there's not a lot of opportunity for profit. There's not a lot of customer loyalty. When I rent cars, I just go to whoever has the cheapest car. I'm not loyal to any particular operation. They've tried to figure out how to create customer loyalty programs, but they really don't work, because what people want is a car that's available to them pretty much at the cheapest price possible. The resale value of the cars, a lot of times it's based on the market at that particular time. So what a lot of times they do is they just do fleet resales, and they're not always allowed to get top dollar, because essentially what they do is they fleet auction their cars off to somebody else that's getting ready to auction the car off. So you have this particular business, but if you look at this particular chart, and let's go ahead and get into it, it's been moving up really, really steadily over the past, I would say, year. So if we're looking at, this is Avis, ticker's car, around January, February, March, April, May of 2020, they were trading at around $25 to $50, right? They moved up, and we want to say around early 2020, they got around $80, and they had some resistance there. And then we want to say is around 2021, they got over $100. So just a few months ago, they finally got over the $100 mark. Now, if we look at this company over a 5-year period, right, look at where they traded at. And so this week's distortion really skewed this chart, but look at where they've been trading at for years. They've been trading well under $100, right? And so what we had is that for some reason, people started valuing this stock over $100 just 2-3 months ago. And one of the reasons is because their earnings were really, really robust, because there was a lack of supply in the used car market. So people were spending a lot more money to access used cars. So when I looked at used cars coming out of Hartsfield, it would have been around $400 for a week for just like a basic, Toyota or Altima, something of that nature. Normally, you can get used cars during the week for about $20 to $30 a day, maybe the weekend, maybe $50 to $100, kind of based on that particular outfit. But normally during the week is when you have a lot less price resistance, because nobody's usually renting cars during the week. Most people, the renters, are on the weekend. So what happens is, as a result of a shortage on cars, they was able to raise the prices. So which means what? We're bringing in a lot more revenue, right? And we're bringing in a lot more profit because of that. However, that scenario is not going to last forever. So then the question is, with the market being a future dated price modeling. So when we're looking at a stock price, it's not necessarily the price that it is today. It's what we believe this company is going to be worth from a price standpoint 6 months to a year out. We're pricing this 6 months to a year out, but we understand in the 6 months to a year, it won't have the same amount of pricing power in the market. So 6 months to a year from now, Avis will not have this pricing power that they currently have in the market. It won't exist. Why? Because the shortage will be eliminated. So once the shortage is gone, things will go back to what they were before, which what we have a very low margin business that does drive revenue, but there's not a lot of profit. But they also have a lot of debt that eventually they're going to have to service. Even if they get some of it renegotiated, they got $17 billion in debt. They're going to have to service that debt, which means what? Revenue, right, and equity that could go to shareholders has to now go to service debt. So just by understanding them from a fundamental standpoint, we would wonder why they're being priced even over $100. I think $100 is a stretch. But like we talked about, what we've seen over the past few months is they just started walking up over this $100 price point, right? And so as a result, they would continue to become valued more and more. Now, their last earnings, I think they had the most profitable earnings they had in the history of the company. This earnings went really well because, like I said, there's a shortage on cars. And so what we saw come out of the gate, and let's go to the 5-day, was they came out of earnings and they just shot up. Let me see, can I zoom in on this? So here's a 5-day. Let me get off the 5-minute candle and go to the 1-day candle. Okay. And so we see this on 11/12. They opened at 174. They closed at 357, but at one time, this price point, and we see this long bar, at one time went past $500, and that was on the day. So when we saw them open and I watched it, they didn't gap up. If you look at that actual day, there was not a gap up on the day. What they really did was they just traded up. So normally, what you see when a company has a really good earnings, they gap up off the earnings. There was no gap up. They just traded up that whole day, and for some reason, there became a lot of momentum behind a particular price. And like I said, I think they got almost to over $500 at one time. We saw options premiums on this particular ticker go to 6 and 7,000%. So that means if you had an option around the $200 to $250 mark that you probably would have paid a few $100s for with a November 19th expiration, you probably would have had an option worth a few $100,000, right? Because you just take the $200, $300 and you multiply that by 6, 7,000%. The problem is that it's almost impossible to see this play coming because of the fundamentals around the company. Now, what a lot of people are going to say is that this play got short squeezed. The challenge with that particular narrative is that there were not high borrowing costs on this particular play. There was not a lack of short shares available to be shorted. For some reason, what I just think is that there was demand for this particular ticker at that time. Did maybe somebody that was short this particular play desire to exit their position? Maybe. But if you can capture that particular day, they did 30 million in volume on the actual date. This ticker normally strains to do 1 million in volume. So the day before that, they did 2 million in volume. The day before that, they did 1.3. The day before that, they did 1.5. The day before that, they did 1.6. The day before that, they did 1. So this is a ticker that barely does 2 million in volume a day, right? But this one day, they did 30 million in volume. That's not from shorts covering. That's from people buying. For some reason, people decided to buy this particular ticker. And then you may have had shorts covering in that, but it was people buying this ticker. The question you want to ask yourself is that why do they value this ticker over $100? Because like I said before, is that that's not the price it should be today. This is the price that we believe it should be in the future. What's interesting about the people that are saying this short squeeze is that if it did short squeeze, let's go with that particular narrative. Let's say it did short squeeze. How come it didn't short squeeze with the dark pool and the shares in Brazil and the shares that are being hidden in Afghanistan and the FTDs or whatever, like all these narratives that have come out of the meme stock space as to why a company will or will not short squeeze? If you believe this did short squeeze, how come it was able to do that without any of those narratives? So what we didn't see is this mass conspiracy around the ticker that caused a short squeeze. If you're adamant that it was a short squeeze that you see around why AMC has not short squeezed yet, because they're essentially, undercutting the price with the dark pools, or why GME has not short squeezed yet is because there's a grand conspiracy through Citadel. How come in this particular situation it's short squeeze? Even though I don't believe it's short squeeze, I just believe that for some reason there was a lot of demand on this particular ticker, and it just became a feedback mechanism where you had a lot of demand. You don't have a lot of shares because they had bought back a certain amount of shares at $80 a share. They bought back so many million shares. So we decreased the amount of the float, and then there was a demand on it. I listened to the earnings call that morning. They really didn't seem that powerful to me. But for some reason, when we came out of the gate, it took off. Now, if you had bought in that morning on calls because you were bullish, you'd probably be sitting on a few $100,000 right now, if not $1 million based on your position. The problem is that it's hard to call these kind of plays because normally when a company has a good earnings, you don't normally that day get this type of activity. Let me show you what I mean. So here's another company that had a really, really good earnings, right? And I want to show you how they traded when they came out. So this is Bed Bath & Beyond. This is what people call a meme stock. It's, quote unquote, supposed to short squeeze. Short squeezes are very rare in the market. So let's look at the 5-day. So what did we see when they came out of earnings? They gapped up, which is normal. They started to sell off and trade horizontal. That's normally what happens in these scenarios. Normally when you have a positive or a negative reaction to earnings, you usually get a gap up or a gap down, and then you start getting consolidation because the market is kind of indecisive about where they want to take the price yet. And that normally happens for a day, sometimes maybe 2 days after. Sometimes you don't get that, but a lot of times that's what you get. You get a gap up or a gap down in consolidation. So if you would have got this on Bed Bath & Beyond, if you buy calls here, what happens to your premium? You lose premium over the course of the day. Why? Because you start to get sell-off. So if you buy calls here on this first bar, which is $23 million on the first 5-minute bar, 23 million in volume on the first 5-minute bar, you buy calls here, it closes red on the first 5 minutes and then it starts to sell off. So then you would get trapped in the play. So this is why this play with CAR is just hard to call it, because what you would have had to do was take a real big gamble that it's going to continue to go up, even on a lot of scenarios where you get a really good earnings, it pops up on the open, and a lot of times it trades sideways, or to sell off and trade sideways is what you see with CAR. Let me show you. Was it Chegg? Chegg had a bad earnings, right? So let's go to their chart, and I'll show you their 5-day. If we can get it to come up. See? So they came out, what's today? 11.4 is today. Let's go to 11.3, 11.2. So here's 11.3, right? So I believe one of these was their earnings. Let me get rid of that. One of these was their earnings. Let me see if I can find what their earnings was. So their earnings was the first. So let's go back to that date. $10.25, $10.11, $11.1. Okay, so they did earnings after market. So here's the day after earnings. So we see 11.2. They gap down, right? After market earnings, they gap down on bad earnings, and they pretty much traded horizontal. So you can buy the put here. You would get some volatility spike, but they pretty much traded down, right? They traded down. I'm sorry. They traded horizontal pretty much that whole day, right? 11.3, not a big sell-off. 11.4, a little bit more of a sell-off. Let's go to the 1 year so we can see it a little bit better. And you'll see it here. So you see the gap down. It was a green day the next day, and it was a red day the next day. So that's the issue, is that you don't necessarily always know after earnings how the market's going to respond to it, even if it's negative or positive. You can get a sell-off, but it doesn't mean it's going to keep selling down. A lot of times that happens when you get bad news that has nothing to do with earnings, right? Some bad news that can fundamentally affect the company, where you get the massive start to downslope, or you get the massive upslope. Now, sometimes it does. Like a firm had a really good earnings. They had a really good guidance. And as opposed to them coming out and selling sideways, they started to ride up. So it's a case-by-case scenario. But the likelihood of you knowing, let's go back to CAR, that it was going to do what it did is very unlikely, right? It just would have been taking a big gamble. So this is why these kind of plays can be lucrative, but they also can be dangerous. Now, if you have an extra $1,000 just to throw out a play, there's nothing wrong with it. But I think waiting for this type of play to happen, it may take you another 10 years. But if you catch it, you be up, a few $100,000 to $1 million, because if you can get $7,000 return on, $2,000, you just take 2,000, you multiply by 7,000%, and that'll tell you what your premiums would be. But you would have had to exit on the upswing. But this thing, it did almost 200% increase in share price within like maybe the first 3 hours. It did 100% within the first hour. I sat back and watched it because I was anticipating it selling off, because it sold off the last 6 earnings. It sold off after earnings. This was the first earnings in 6 where it did sell off. So all the trends was telling you that it was going to sell off after earnings. So it did 100% increase from the open price to where it was currently at in the first hour. And by, I think, the third hour, it was at almost 200%, right? And then it came down a little bit, but I think it closed at like 89%. So it was just a massive move on this particular ticker. We want to see how long it's going to take to try to settle back down, because like I said, it opened that day at 174. How long will it take to get back down to 174? But in looking at this particular company, who believes this company 6 months to a year is going to be worth $270? So they may have another good quarter, but from a year from now, do you believe CAR's price point can justify a $270 share price? Because that's really what this means. It doesn't mean the price today. So that's this kind of play. It just really, what I really want to show you is the amount of money in this market, the amount of opportunity, because I think once a person really witnesses it, they realize, because of the liquidity in these particular markets, it's really easy to make yourself a lot of money, but to make yourself rich. And in any business, success is about timing, but you can't force it. It just happens. But in any business, success is about timing. If you're born 30 years too late, there's businesses that won't make you a lot of money. If you're born 30 years too early, There's businesses that won't make you a lot of money. There's not the kind of money in the rap game today that there was in the 80s and the 90s and the early 2000s, right? It's just not. It's a different game now. So if you're just born a little too late or a little too early in business, it can affect the money that you can make. You can't force it. And what a lot of people are trying to do, and I see this in the meme stock space, is we're going to try to force this type of activity. Well, I've never seen anybody do it yet. If you look at the Volvo plate that they talk about, I think it's the Volkswagen plate. That was a massive short squeeze. Nobody forced that. It just happened. What they're trying to do is force a short squeeze. Nobody's been able to do that, right? Nobody's been able to figure out how to do that. And so we want to continue to observe, will they get the short squeeze that they think they're going to force by essentially accumulating the shares? Because if you look at this plate, the reason why it worked is because people kept buying at higher prices. So it opened at 174. We see that the bar goes up past 500. It closed at 357 for the day. What does that mean? People kept buying at higher prices. When we're looking at the AMC GME play, what we see is a lack of desire to buy at a higher price. Because if that happened, it wouldn't be at $35, $40. It would be at $150 for AMC. But nobody wants to buy at a higher price. They want somebody else to push it up. And that's not how these plays work. They work because everybody keeps stacking on top of each other. But nobody can emotionally deal with, I just paid $150 for an AMC share. But I thought you said it was going to 1,000, so you shouldn't have a problem paying $150 for it. That's the psychological lie that they can't get over. So me, by observing their behavior, I don't think they really believe that this is going to happen. I think they want other people to believe it, but they don't really believe it, because if they did, they buy it for a higher price. So we got any questions on that particular play? Or do we got any questions on options at all, period? I'm going to go ahead and start rolling through the plays, rolling through the questions. So Jigga says, when I'm like, I don't know what NG means. What timeline on the charts do you look like? What do you think swing plays on Saturday, Sunday morning, and put in your order Monday morning? So everything is case by case scenario. There's a really good video on my channel put out by Lance Hemington. I think it's BH Capital. I think I might have that correct. It's a video I put out maybe a week ago. And she talked about looking at charts and breaking down, your 10-year, your 1 year, your 5 year. I would encourage you to look at that video like 10 times, because essentially that video is a course, right? And you're getting it for free on my platform. She's a very, very accomplished technical analysis trader. She has the results to prove it. She just doesn't do YouTube videos. She actually makes money in the market. And she's been very, very successful for a very long time. So I would look at that when you start asking for timelines, because I'm going to send you in her direction, because she's the go-to person for technical analysis. And she's an actual practitioner. She's just not a person that does YouTube videos to try to get stream money and to try to get views. I look at a lot of plays on Sunday just to try to figure out what I'm going to do during the week. And I missed my Zoom play because I knew about it on Sunday, but because I was kind of frantic because of a move and trying to get things together with where I'm living, I missed that play, and I missed a lot. I probably missed a few $1,000s between Monday and Tuesday. But normally what I do is I spend maybe 3 to 4 hours on Sunday looking at plays and kind of figure out, how do I think the week's going to roll out, right? But that doesn't mean I play it on Monday morning. I just wait to see how I think the week's going to roll out. What I'm finding out with me is that if I'm a lot more patient, I'm a lot more profitable. When I play things in a rush or trying to be frantic, I end up making bad plays. So just because I see something doesn't mean I need to play it, because what I find it with myself is a lot of times the easiest opportunity makes me the most amount of money, right? So it's like in basketball. Sometimes the easiest shot is the best one to take, even though a lot of people want to take a hard shot to feel like they did something. Sometimes taking the easiest shot is the best shot. So what I've learned a lot of times with me is making the easiest play is the one that makes me the most amount of money in the least amount of time. But I got to stop looking for hard scenarios to kind of justify my existence as a trader. So I would encourage you to look at her video. We did an interview and we broke it down. It's like an hour's worth of content. And then apply that from a timeline standpoint for swing plays to your trading. And then if you want more education, you can reach out to her because she has a really, really extensive technical analysis course that has produced a lot of results for a lot of people. And her price point is well below the value. It's a little over $1,000, and she should probably be charging $10,000 to teach what she teaches, because she can teach you to become free via the markets. And for her teaching you that, she should charge comparable to what a college charges. And most colleges is charging you, a little south of $100,000 to make sure that you're tied to a job the rest of your life. But that's a good question. I appreciate it. GC, I appreciate the super chat. Yes, the VIX is necessary. I look at the VIX a lot of times just to try to understand, because the VIX can impact premiums, especially if it's going up. A lot of times people call it an anxiety tracker. But a lot of times if the overall market has a lot of anxiety or a lot of apprehension, it'll spike the VIX, which sometimes can impact premiums. And what you got to understand is that when you're looking at implied volatility in premiums, if you pay a lot of money to buy the contract because of a high volatility, if that doesn't continue to go up and it softens, you'll lose money on the contract, even if you get the price movement that you're looking for. So one time, a lot of people struggle with options because there's a lot of pieces that you got to be able to kind of manage at one time consciously, similar to driving. So when you're driving down the road, your brain is doing a lot of calculations at the same time, but you're not conscious of it, right? As an options trader, you have to do a lot of calculations at the same time, but be conscious of it. That's where a lot of people struggle. So you want to always factor in, where is the VIX? But I don't become obsessed about it, but I do sometimes watch it. But I also can watch the overall market to kind of determine where the VIX is at. But then sometimes the market can be bullish, but the VIX can be going up. It's because people are fearful of the future. So they're trying to position themselves for a downturn in the market. So sometimes those can be indicators, but it also doesn't mean it is an indicator. It means it can be an indicator. So a lot of people specialize just in trading the VIX, and there's a lot of money in trading volatility. But I would hesitate to just listen to volatility traders, because a lot of times they only make money when the market is volatile. So they see every scenario as an indicator of volatility, because that's how they make their money. They don't make money when the market is flat. So they need the market to be very volatile for them to capitalize. So they see everything as an indicator of volatility, and they may start to program you to see the market the same way, even if it's not like that. Julian Brown, I appreciate it. Yeah, it's a low volume ticker. So a lot of times it won't even show up on a lot of scanners, because there were days in which it may do $300,000 in volume, 300,000 in volume. So it's a very low volume ticker. It moves very, very slow. It's very thinly traded. And so that's probably one of the reasons why it didn't show up on a lot of scanners. But I have been watching it because I was looking for plays a little bit after February of companies that had been driven up because of the pandemic that I knew were getting ready to come down. And this particular company was one of them, because I didn't understand why people started to value this company at a higher price, because they got hammered because of the pandemic, because of the lack of air travel, but they never traded at $100. If we looked at their 5-year chart, they were never at $100. So I didn't understand why people wanted to value this company at the higher price, because it really was not a reopening play. They're going to pick up some business because of reopening, but they're not going to pick up more business than what they picked up, 5 years before the pandemic. And because of a lot of competition in the space with Turo, Hide Car, Uber, things of that nature, the rental car space has to figure out how to transform themselves, because now you don't need to rent a car. I can come land in the city, take an Uber to the hotel. If I have the event in the hotel, I don't really need to leave unless I want to go get something to eat. I can Uber to the restaurant and back. I can do Uber Eats or DoorDash or whatever for delivery. Then when it's time to go back to the hotel room, I can Uber from the hotel room back to the airport, and I never had to rent a car. So they're under a lot of competition in that particular space, because now the way our economy set up, and because of ride sharing, it's an easy barrier. There's a low barrier to entry to get into that particular space that necessarily didn't exist 25, 30 years ago, when they was able to make a lot of their money, right? Yeah, it had a pretty big, 20% is a high short ratio. But if we looked at the availability to short, it wasn't an issue. And what's funny is that it had a 20% short ratio and we saw this movement, right? GameStop and had a much higher short ratio. AMC had, they were telling us that AMC was 100 or something shorted. And we still didn't get this type of movement on AMC or GameStop. And if it had been shorted, to me, it should have sold off really rapidly once the short's covered. And we haven't seen that. We've seen, if we're looking at the chart is right behind your particular post, it hasn't sold off. It hasn't slammed back down. So a lot of times when you get a short covering, once the shorts cover, they cover and short right back down again. So they cover it and short back at that higher price. We haven't really seen that. So I don't really believe that this was really a short squeeze. I believe people for some reason bought this. It may have been a haywire computer. It may have been a computer algorithm that went haywire and for some reason just started buying this at a higher price for whatever reason. But I don't believe it was a true short squeeze because the day after, and we're now 2 days after this particular play, it hasn't slammed right back down, which is what it should do. Once all the shorts cover, they should short right back again at the top. Okay, here's we go. Okay, so they got to deal with Kroger to sell its products inside the stores. Okay, yeah, there's no Krogers in my area, so that's probably a good regional deal. But there's no Krogers in my area. I think there's Randos and HEBs here. Yeah, I missed a bit. There's no big. There's a million plays out there, and it wasn't a really good ticker to watch because, like I said, that there wasn't a lot of volume on the ticker, so it was really a very boring play because there's not a lot of volume, which means that you didn't get a lot of volatility in options contracts until this particular scenario, right? So I had it long-term going down, but I didn't understand over the past few months since really September why it started moving up. But there is a lot of institutional buy-in on this ticker. So institutions are heavily invested in this ticker. But I didn't understand who wanted to buy this at a higher price 2 months ago. Just didn't make a lot of sense. But I also don't understand why DoorDash is trading at $200. So you got to define what old news means to you. That's a subjective term. So let me give you an example. If Peloton today announced that they're not going to be positive until 2023, that's not going to be old news tomorrow. It's still relevant. It's relevant the rest of the year, unless that changes. So you got to kind of define what old news means. And I want you to try to ask yourself, are you looking at things like you got to be the first to make the play? Because that you'll never be first, right? Because you're not on the ground. You also don't have inside information unless you do, and then you do have inside information. So if you're worried about news being old, are you looking at things from the standpoint of that I got to move before everybody else, right? And it can be difficult to trade that way if that's your perspective of the market. And what I'm looking at in news is that I'm looking at anything that can change the fundamental perspective of a particular company. I don't know if you bought the course, but I would tell you to try to really understand what makes a company valuable and then what can change that fundamental analysis, right? And then also look at the actual videos we did on supply and demand. And so what changes supply and demand in the market, right? So if we have a demand on a particular share price, what changes that demand desire? And if we have supply, what makes people want more of that particular share? And, kind of review those, but ask yourself from a fundamental analysis standpoint, what changes the fundamental analysis? So if we know that there's a demand for a particular company, what changes that demand? And that's actually in the actual course. It's the videos on charts in which I kind of explain what a market is. One of the biggest challenges we have inside the United States is we don't teach people how markets actually work. People are trading and can't even explain to you how a market works. So once you understand how market works, then you kind of understand what is creating the behavior or what questions you have about the behavior based on the fundamentals of a market. But we got a bunch of people in the stock market that are trying to get rich and they can't even explain to you how markets function. But that's not their fault. That's a byproduct of their education system. But I appreciate the question. So first I do is I concentrate on my individual tickers. And I look for situations in which I think there's an inefficiency. So with Avis, what was I looking at? The share price is really higher than the value of the company because of the fundamentals. Doesn't mean that it's going to go the way I think it's going to go, but I believe that the share price is higher than the value of the company. So my question is, when would a market start to value this particular company or price this company at its real value? So let me rephrase myself. I think the share price is higher than the value. So when do I believe the market will reset the share price in comparison to the value? Because you have this in the market to where people will price something higher than the actual value, but eventually they will come to their senses, and not because the market is efficient. The market is not efficient. The market is inefficient. But a lot of times people will realize that I'm not able to get the return on this particular company because I've overpriced it. So let's say you're looking to get a 7% return on something based on its cash flows. And you believe that these cash flows are going to allow you to get a 7% return. Those cash flows become threatened, and now you're getting a 3% return. Well, what a lot of times you'll do is you'll take your money somewhere else where you can get 7% because you were looking to get 7%. So when I'm looking at a company, my question is it undervalued? I'm sorry, is it underpriced in comparison to its value? And will the market eventually start to see it that way? Or is it overpriced in comparison to its value? And when the market starts to see it that way, and in what events do I think would change it? Or what indicators on the chart do I believe are getting ready to make that particular change? So that's normally what I look for. Yeah, I try to stay away from earnings because they're very volatile. And there's a video in the actual course about earnings, about how a lot of times the IV spikes. And then if you don't get the expected move, the IV softens. So if you buy in early, if you buy in, really close to earnings, and your expiration date is really close to after earnings, it can put you in a position where you get IV crushed. So you can buy around earnings, but it can be very hard to become consistently profitable because of that, right? So that's one of the challenges of buying around earnings, is that the IV spikes. If you got a contract that you buy right before earnings that's going to expire right after earnings and you don't get the expected move, you get IV softening, which means that even if the share price moves in the direction that you want, because you get an IV crush, you get a loss in premium, which affects the value of the contract. So you just got to be careful buying around earnings. And I tell anybody, if you buy with the intent to hold after earnings and to sell immediately after earnings, I would just track it over the next year every time you do that, and to determine whether or not that's a profitable strategy for you, right? Because if it's not profitable long term, it's going to be hard to continue to stay in it. So like with car, that one play could have made your year. But the problem is, if you try to, how many plays did you fail at before you were successful with that one play? And that's the question nobody asks. They just look at the one scenario. But unless you just going to be one and done in the market, how long do you do that? Just like with the meme stocks, as a guy said he did $1 million off options. Well, he's 24 years old. That $1 million is not going to last him the rest of his life. So unless he really learns how to trade properly, he can't depend on another AMC to make himself rich, because there may not be another scenario just like that. There's going to be other similar scenarios. But he caught that at the exact right time to make $1 million in options. The question is, do you really understand how to trade it? Do you just catch AMC at the right time? You got $1 million, but at 24 years old, $1 million is not going to last you the rest of your life. You go to Atlanta and you buy a house in certain parts of the city, and you'll pretty much spend that whole $1 million. Her name is Lance, but the video is on my particular channel. So that's a relative question. So again, what we got to try to get away from is asking questions that have to do with us and very little to do with trading. So let me ask you a question, Inner Black Beauty. If you're bad with money and I told you $1 million, would it matter? Right? So I'm asking you that question, and I'm asking you to give me a response. If you're bad managing money and I told you $1 million was a sizable budget, you had $1 million, but you're just terrible managing money, would it matter what size? So the question you want to ask yourself is that, how good am I at managing funds? Because if you're terrible at managing funds, there's no course that's going to be able to defeat that. That's the issue that you had before you ever came into the market. So I tell people, the reason why I like the options market is because it provides a lot of leverage. But many people have issues personally that they're bringing into the market that they haven't dealt with, that they now looking for the market to give them a justification. Doesn't work that way. The market is going to essentially show you who you are. So if you're terrible at money management, the market is going to make sure that you're terrible at money management, because the market is going to show you exactly who you are. So I like the options market because it allows people to come in with a smaller budget and become successful. But if you're bad at managing money outside of the market, you can start with 30 cents and you'll blow that. And you can start with 30 million and you'll blow that too. Why? Because you're bad at managing money, right? And so you would need to deal with managing money, which is a personal issue, got nothing to do with the market. So I would ask you, if you're bad at managing money and you had $1 million to trade with, would it matter that you got $1 million? And then we can start talking about numbers, right? Yeah, definitely. So Hertz is buying cars and releasing them to Uber drivers. But most people that's doing Uber is doing their own car, because that deal where you rent a car to do Uber is not a good deal, because it's already hard to make money as an Uber driver anyway, to be profitable, unless you just essentially live in the car. So you could always, even before that deal, you could rent a car from Uber to actually drive Uber. But it's hard to make money because that's more money coming out of your profit. Because like we talked about before, is now you owe Uber money. So now your revenues are strained, because not only do you got to pay your gas, your wear and tear, then you got to get compensated for your time. You got to pay Uber for the car rental. So it's going to be interesting if that deal is going to really work for Hertz, because most people that's doing Uber is doing their own car, which is why I'm not a fan of Uber, because you're putting a lot of wear and tear on your car to make that money, right? And you just putting a lot of miles on your car. Yeah, I think they got downgraded to, I think, 140. And so that's the issue. Like I said, they haven't sold off really hard. So that's why I don't believe it was a short squeeze, because normally with a short squeeze, you see the run up, then you see once the short's covered, just slams right back down. You haven't seen that, right? They're almost consolidating, which is weird, because who thinks that particular company is worth who thinks Avis is worth almost $300 a share? And what do we think they're worth $300 a share 6 months from now? Right. So in the summer of 2023, will Avis be worth $300 a share? I don't see how. But like I said, I really think it was a computer that bought all those shares up. I don't think it was people doing that. Yeah. So I guess that's how they're doing it. I haven't been in the Bed Bath & Beyond in a long time. And I think, is there Kroger's in Atlanta? It might be. I'm not a real Kroger guy, but there's no Kroger's in that I know of in Florida. And definitely not where I'm at now. Yeah, definitely. So yeah, I look at news related to the stocks. I look at news specifically related to that particular company, what I think is going to impact those particular companies. And, but I would tell people to really kind of understand business, because I say it's going to be hard to be a successful trader if you don't enjoy business, because all we're trading is businesses. And if you're a commodities trader, you trade futures, it's 100% fundamentals. It's all news. Commodities trading is 100% news. They just trade news all day. So I would really try to get an appreciation for the space of business and really start getting into that, and then starting to see yourself as a trader, as a business, right? Yeah, definitely. Because I used to do sales, I know when people are asking me questions that have nothing to do with the actual offer. So what you see is a lot of times in sales, people try to justify saying no by asking a question that allows them to say no. Or that's a big thing that people will do. So, they'll say, well, yada, 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 because I want you to give me an answer where I can now say, well, that won't work for me. And just instead of just saying no. Or I'm trying to excuse something that I got going on by saying, well, I can't do it because of that. And so it takes way less money up front to trade options than it does to trade stocks. Most people would tell you it takes $25,000 or $20,000 to trade stocks because that's how you get around the pattern day trade rule. Doesn't take anywhere that near to trade options because of the amount of leverage. And one of the reasons why I got into this particular space is because I wanted to get people into trading and not feel like they needed $20,000 because it can be hard for a lot of people to get 20 grand at one time. I started a lot of my accounts off with $250, but I grinded those things out. A lot of our people, because of psychology, we don't act until we're desperate, and then we want things to happen like that. So we don't appreciate process. If I told you, if you start an account with $250, in 6 months, you could probably be up a few $1,000s. In 2 years, you could probably be up $100,000. Most people wouldn't stick with it for 2 years because they didn't come to me until they were desperate. So they heard about the offer, but I'm not desperate and I don't have the foresight to realize I need to change my life. So I don't act. Then when I'm desperate, I act. And now I need an overnight situation. And that's how a lot of our people conduct themselves, which is why it's hard for us to get out of our situation because you don't want to wait until you're drowning to ask for help. You want to ask for help as soon as you fall into the water. There was a guy I know that does Forex. He's in the UK. His mentor told him after he trained him, I want you to paper trade for 2 years. So for 2 years, he didn't make any money. He paper traded every day for 2 years. After 2 years, he had got his trading strategy down. He had figured out the market. He understood how Forex moved. He understood what currency he was best at. He understood what particular trading. There's different sessions that you can trade Forex at. He understood what session worked best for him. After 2 years, he was killing it. He was doing $30,000, $40,000 a month trading in profit. But he sat down for 2 years. Most of our people, when we're looking for an offer, we wait until we're desperate. Then we need an overnight success. That's why we get scammed by so many people, right? Because they know that we're playing to our desperation. So we buy into these deals that are never going to work. But I'm sold on the fact it's going to work fast. I need a 60-day turnaround instead of me saying, give it 2 years. I tell people all the time, just focus on the markets for 2 years. Just focus on developing yourself in the markets for 2 years. And you'll be amazed how profitable you'll be at the end of 2 years. And then you can write your own ticket. But that's a struggle if I'm desperate, right? But it is what it is. I can't change the psychology of a person because I don't have control over that. But until we start realizing that when we're comfortable, we need to start preparing for a lack. Just like, when you're farming, when everything's going good, you got to start preparing for the drought. You can't wait till the drought to prepare for the drought. Until we start changing that kind of mindset, we're going to have a hard time getting out of these type of scenarios because most people get scammed because they're desperate looking for something. And the scammer creates language to reach out to desperate people. They don't create language for people that already got it going on. Okay, so if you're disciplined with money, and I appreciate you responding back to it, I would say start account between $250 and $500. That's not investment advice. And if you're disciplined and you're process oriented, you can continue to build that account because money compounds. That's the good thing about money, because trading is nothing but a game of percentages, right? So if you're disciplined with money, I would encourage you to start an account between $250 and $500. And over time, that account will build up because money compounds. That's the benefit. That's the power of compounding money. But you got to be disciplined. And what'll happen is before you have a downturn in the market, with most people, their lack of discipline will destroy their account. It's not the market. But if you have any kind of psychological deficiency, you will not be able to hide it in the market. The market will expose them and bring them to the forefront, because that's what the market's really good at. It's good at figuring out what psychological challenges you have and manipulating them. So that's why I tell everybody the number one job as a trader is to manage risk. Most people can't manage risk properly, and their life is a result of lack of risk management. So that they go into the market, and the fact that they can't manage risk properly comes out in the way they trade. Then they go do something else because they have never dealt with their challenges as a person. So let's go to the next thing, to where I don't have to deal with my challenges as a person. So one of the things that we do in my particular course is we try to get people in the VIP course to deal with somebody that can get them to identify their psychological challenges and not allow them to become successful. But you got to be willing to take that journey. because every time I mess up a play, it's always me. It's never the market. The market, nothing the market does really surprises me. Is a lot of times I go against what I know I shouldn't do, my own rules, because of a lack of discipline. So I know I shouldn't do it, but I do it anyway. And I pay for it by giving money back to the market. I know a guy in Miami, all he does all day is take 20, 30% profit. He'll take an account with $2,000 and in 90 days, he'll have $30,000 because all he does all day is take 20, 30% profit. He's disciplined himself to he doesn't care what happens after the 20, 30%. That thing can go to 30,000%. He just takes 20, 30% profit. But he's been trading so long, he's just disciplined himself to do that. He just takes 20%, 30%, 20%, 30%. He just keeps doing it over and over and over again. So he can take an account with $2,000 and in 90 days turn that thing into a $30,000, $40,000 account, because he right now is going to turn an account into $1 million. And I believe he can do it because he just trades like a machine. He just takes 20, 30%. And that's really what they teach you when you go work for these funds, is to just take 20, 30% and get out. Take 20, 30% and get out. They don't really look for big runs. That's what they teach retail traders. The professional traders, they happy to get 20, 30% and they leave and go do something else. But they've been disciplined to trade like that. And it can take a long time to where you just see it like that. Because a lot of times, like I say, we're desperate. So we're coming in trying to make a lot of money in a short amount of time to justify why we're here, as opposed to knowing I'm going to just keep taking 20, 30% the rest of the year. And at the end of the year, I'm going to be up 70, 80, $100,000. Yeah, I'm from the Southeast, so Publix is real big. In fact, I'm from the state where Publix originated. Yeah, so I think there's some Kroger's in Atlanta, but I haven't really been into them a lot. I forgot what the other store I used to go into when I lived in Atlanta. But yeah, Publix is all over the Southeast. They're real, real big. In fact, they're one of the few stores that was able to withstand the Walmart superstore model. Okay, wow. I don't know what you're saying wow to, but I appreciate it. There are no basic trading strategies that beginners should learn. What you should understand is basic macroeconomics, and truly not watch Thomas Sowell videos on YouTube. That's not how you learn it. You need to study microeconomics. Not watch, Milton Friedman videos. These guys are not telling you the truth about how economic systems actually work. Actually understand macroeconomics from a fundamental standpoint, and then be able to apply that education to the real world. Right. So you don't need to learn a stock trading strategy. They don't exist. No such thing. It's like saying there's a basketball strategy. Doesn't exist. There's a way to play basketball based on the fundamentals of basketball. There's no strategy. There's not even moves in basketball. Like personal moves don't exist. There's a way to play basketball based on the fundamentals of basketball. Once you learn that, then you create your own move, but you don't learn other people's moves. So learn macroeconomics from a fundamental standpoint. Because if you don't understand how markets actually work, then you don't have any reason to be in the stock market. You don't have any reason to be in the futures market. You don't have any reason to be in the real estate market, because you don't understand how markets work. So a lot of people are trying to learn technical things and they don't even understand how markets function. Right. And then once you learn that, the next thing you need to really understand is your psychology, yourself, what makes you tick. Because you can learn every strategy in the world, but if your whole life you have been defeating yourself, it doesn't matter what strategy you learn. Just like the guy that played for the Raiders, the Vegas Raiders, that drank all that alcohol and then got into a car. I think he went 120 to 156 before he crashed and killed that other woman. What does it matter what football strategy that he learned? Or what does it matter what formal education curriculum he learned? He defeated himself. Nobody did that to him. He drank all that alcohol and got behind the wheel of a car. So he was his problem, not formalized education, not strategy. He was his problem. So because he was his problem, he played himself out of his own success. He was going to do that anyway. Why? Because he had never figured out how to master his own psychology. So it was just a matter of time. NFL didn't have nothing to do with it. He would have did that without the NFL. Because if you got $16 million guaranteed and you don't have the sense to hire a driver, you was going to always do that. So this is what people got to really understand. And this is what we try to teach people in the VIP course is you are the reason why you're not successful or you are successful. All the rest of these things got nothing to do with it, because if you got $16 million guaranteed and you will not go hire a driver so you can drink how you want to drink and to get behind in the back seat of a car and let somebody else drive you home, you was going to always defeat yourself, regardless of any formalized education that you get. It was going to happen anyway because of whatever psychological challenges that you had going on before you ever came into the NFL. Because I would bet you money that guy has substance abuse problems in high school. Because when I got into high school, I ran into a lot of people that had substance abuse problems that I didn't even understand that was a thing until I got into high school. A lot of people's substance abuse issues start as teenagers. Yeah, definitely. And it's to different degrees. So I have a certain level of discipline, but I got to continue to work on it because overtrading is one of my challenges as a trader. I overtrade. And what I find is that if I trade less and go for easier trades, I'm a lot more profitable. The Peloton trade, that's one of the easiest trades I made all year. It's probably going to be one of the most profitable trades I made all year. And I didn't have to fight it. It just came real easy. So I have a tendency to go into hard situations as opposed to taking the easiest situation. And like I said, is that I got to keep working on my psychology, keep listening to my mindset material, because that's really going to be my leverage. Because I told people probably a year ago that my goal is to become so successful, I can go to a therapist every week, because that's my real leverage as a trader. It's not trying to figure out the new stock trading strategy. That got nothing to do with anything, right? That got nothing to do with nothing. Most people defeat themselves because of themselves, not because of external stuff. That's not the reason why they defeat, because people got everything going for themselves and they still defeat themselves. So we know that's not the reason why they get defeated. Yeah. And really, that's how you should do it. Because if you're going to blow $500, you was going to blow $10,000. So it's better to blow $500 than to blow $10,000. Right? Because if you're going to blow it, you're going to blow it. So that's why I tell people, start with $500 and see, can you deal with that? Because if you're going to blow 10,000, it's better to blow 500 than 10,000, because now you're 10,000 down. And a lot of people will get $500, work it till 5,000 and then blow 5,000, which means what? They was going to always blow 5,000. So until they deal with that, it don't matter how much money they start with. See what I'm saying? So the market exposes people. That's why a lot of people can't stay in this space long, because in a lot of other areas, you can hide behind stuff. You can't hide behind this market. This market will show you exactly who you are as a person. It brings it out of you real quick. And a lot of people can't deal with that because, like I said, as they built their life believing that everything is external is a solution to their problem. All right. So Black Beauty, I would tell you to go to the link right here and tap in. And don't go for the cheapest option. Invest in yourself and invest in the result that you want to get. But I would tell you to come through, because the price is going up. The goal is to make all my courses premium courses because of the results that we have. Right now, I'm giving away the information, and we're going to stop doing that in a minute. Because one thing I know psychologically is when people don't invest in something, they don't sacrifice, they don't value it, which affects their results, right? So when you make a really low barrier to entry for people, they don't feel like they lose if they don't do it. So then they don't do it. So what we got to do is raise the investment that people got to make in themselves to get the success that they desire. Because people that have followed the curriculum, they're pushing thousands of dollars a month out of the market. And some of them pay me way less than that. And I'm not mad at it, because that's what I was selling it for at that particular price. But the goal is to continue to push it up, because unlike a lot of people in this particular industry, I actually have results in people that I've been able to produce. And I'm not a professional educator either. I just got a lot of game. So we got any questions before we get up out of here? We have 59. Yeah, I'm still sometimes an overtrader, Katrina. That's just what I got to really work on. I got to work on trading a lot less. I might go to like 3 trades a week. I need to start doing that and just work on those. It's just I see so much stuff amongst the companies that I'm watching. And like I said, there's a lot of times I put myself in tough situations, and I should just take the easy trade and get up on out of here. Yeah. Yeah, I'm not a fan of either one of them. But I'm an economist. I'm a trained economist. So I got my own perspective on economics. But I do this in real life. I don't do this in an academic setting. So that's the difference between me and Sowell and Freeman. They're academics. I don't get paid to like theorize this. So like what I built with the highest paid part-time job in the world, I've done that in real life. It's not academic. It's not theoretical. I've been actually applying what I believed in the real world for a very long time. So I don't have theory on this stuff. I have actual real world examples based on how the world really works in real life. So economists are valuable. Academics are valuable. But a lot of times it's more valuable is going out here in the real world and applying what you think is true and letting the world show you whether or not your assumptions or your hypothesis are actually true, as opposed to sitting in an academic setting and just debating who has the best theory. Because a lot of people that are fans of these people have never applied any of the stuff that they think is true in the real world. They're just fans of information. I really do this in real time. That's what separates me from a lot of people. And I didn't start doing this. I've been doing this. I'm just in this particular space now. And like I said, as I'm not an educator, I just got a lot of game. So that's why I'm not a fan. I'm not saying that they don't have, they're not able to make a contribution. But to be real with you is that there's never been a revolution in the history of the world that was created by academics. Because you got to be able to take that stuff and put it into the real world. And academics are taught to just be academics. But, you know, they do what they do. I know it's a Chinese company. That's pretty much about it. I know they got regulation that just came on the 1st of November that was supposed to impact, I think, their revenue. But outside of that, but to be real with you, that might have been one of the companies that me and Lance broke down on video. So I would tell you to go look at that video. Yeah, definitely. It can, because, you know, if you're over trading and your account's down, it'll kill your account. And that's something that a lot of people struggle with. And I still struggle with that now. So I got to really discipline myself to really make a lot less trades. Because a lot of times you can want to trade a lot more than you need to be. And be very confident in the compounding power of money, which it does, right? It will compound. That's one thing money does. It compounds either for you or against you, but it does compound. That's why the credit card companies sell you that particular formula for compound interest, because they know they're going to make money off you the rest of your life. So we got any questions before we get up on out of here? Because we got 102. So we got 34 people. So I may start doing the where you got to be a sub to ask questions so I can get some more subs. So we got 34 people on the chat. We had like maybe 6 or 7 people ask questions, but that's kind of how it goes. That's kind of how the breakdown is. Well, so the question of dang, but you got to ask yourself what's going on inside you internally to make you fearful and reluctant, right? Because that's something you brought into the market. It got nothing to do with the market. So there's something internally going on inside you that's making you feel that way emotionally. And you brought that into the market. It got nothing to do with the market. So you want to ask yourself why that is why is that going on inside of you? That's affecting your ability to trade. Because it's not just affecting your ability to trade, it's affecting you in other areas of life. But trading is really polarized and identified for you. Because one thing the market will do is it'll make you show you who you really are at that particular time in your life. Which is why a lot of people come into this space and they leave because there's nowhere to hide. And a lot of people can't deal with themselves. Right? Who they really are, they can't deal. That's why a lot of people can't sit in a room by themselves, because they can't deal with themselves. Right? So we got any questions before we jump on out of here? And I would tell you to look at the courses. Like I say, we going up before Black Friday. We raising the price point. The goal is to get the core course to $997. And to probably get that VIP course to over 2,000. Because once I drop the I dropped the short sellers course inside the VIP course. That's easily a $10,000 course, because the short sellers course, that can be a whole course, but I'm gonna drop it as a module inside the VIP. That's easily a $10,000 course, easily, just because of that content along with everything else. But we're gonna get it there. The goal in 2021 is to do a live event and to get me into different markets. So I started off with a particular market, but to expand, because I was reading this really good article about this Chinese dude in T-Dot, and how he was able to take different ethnic groups that normally wouldn't work with each other. The Flores brothers did the same thing in Chicago, if you know about the Flores brothers, and utilized them to build up the syndicate. And these was groups that normally wouldn't have anything to do with each other, but everybody had a position in the syndicate. So everybody made a gang of money. And so that's something that I may be looking to do, is to get into different markets, because there's a lot of money out there for what value I can bring. And I don't want to just be boxed into one market that may not necessarily see my value, because that's one of the way he was able to make so much money, is he was able to bring a lot of different people. I may link that article on my YouTube channel. It was a really good article I read today. Dude was a genius. But he did something. Flores brothers did similar in Chicago, where they got outside of the Latin market and started dealing with a lot of different people. And that's why they just made so much money, because they was dealing with everybody. Well, historically, Mexicans in Chicago kind of only dealt with Mexicans in Chicago. They was like, nah, we going to do business with everybody because we trying to get it. So I'm kind of looking at it from that standpoint. So that's kind of what we're looking to do in 2020, was it 2022? And also do a live event. I'm looking at where I maybe can get a venue at. I want to see how they report earnings, Urban Homesteader. Long term, I think they can be valuable, but it's like, long term, I'm talking like maybe a decade. And that's something that I think the CEO, the guy with the real crazy hair, he said that if you're buying into this particular company and you're looking for a short-term return, he was like, you're in the wrong place. So this is a long-term place. So long-term, I think they're valuable because of the line of business that they're in and because of their relationships, but it could be a 10-year play. I wonder how long it'll take them to get over $100. So this may be the time to really get in. It's not investment advice. But because of their relationships, I think they can be valuable. But I think it's a long, I think it's one of them plays where you just buy it and go to sleep on it and just look up in 10, 15 years and see where it's at. Don't worry about the day-to-day movement. But I also want to see how they report earnings coming up. But I think they're a long-term play. I think a lot of solid tech plays are just long-term plays. I think Tesla's a long-term play. Even though its price point is where it's at now, I think Tesla's a 20, 30-year play. I don't think it's a 5-year play. So if you're willing to get in and just sit on it, it can be profitable for you, but you got to sit down on it. Same thing with Apple. I wish I would have gotten an Apple 10 years ago, but I didn't. That's why I'm in them now, because I think in 20 years, they're going to be worth way more than they're worth now. So I don't care about the day-to-day movement. I'm just in there, keep accumulating, and I'll look at it in 20 years. Because I think long-term, same thing with Amazon. I think Amazon, if they don't split, they on their way to $5,000 a share. I knew about them in 2005, but I didn't know about stocks then, right? Because I'd be sitting on an island somewhere. So, I just think certain plays are really just long-term plays, 10, 15, 20-year plays. And if you're willing to just be patient with it, it'll work. Okay, so they're getting into crypto. Okay, I feel you. I want to see what they're going to do into that. Because I knew a woman that was in the Navy. And they were doing some stuff in the Navy. They were doing data for the Navy. And so she told me about them first before they even went public. Because they used to do data, providing some type of data for, I don't know, the aircraft carriers or something, but she was in the Navy. So she was the first person to tell me about them before they ever went public. So they do what they do. They have some weaknesses in their business model. But like I said before, I think they're just a long-term play. I'm not a big fan of Uber. I think Tesla's a better long-term play. I don't like Uber because I don't know how they drive more revenue as far as with ride sharing. My question is, if you raise your price, you get less. If you raise your price, you get less riders. If you take money from the drivers, you get less drivers. So to me, you're boxed in revenue-wise, right? I think Tesla can make a lot of money not with the cars. I'm not a fan of car manufacturing. It's a low margin business. Their data mapping, if they can license that out, they're gonna make money to the day they die. That's like saying I got Michael Jackson publishing. Like you're just gonna print money every year because all these car companies, and eventually we're going to go to, autonomous driving. That's where we need to go anyway for a safety standpoint. Tesla with their cars has mapped out so much of the road. They can feed that data into computers, and the computers now know the road. Because now, I know because I drive a lot, you don't know the road until you're on the road. Even if you're looking at a map, you don't know it till you're on it. Then you know how to roads actually drive. So it's certain roads I get on and I'm very comfortable because I've driven the road. Like I said, 75 from Florida to Atlanta. I can drive that road with my eyes closed because I know how it drives. Tesla, because of their data mapping and their cars as they drive, their data mapping. So they're accumulating data. They can sell that data to other companies who don't have that data. That to me is the real value in the company, not the cars. I'm not a fan of cars. This is a low margin business. But I give them credit. They learned how to manufacture an automobile, and they needed to manufacture the automobile to get the data. But to me, that's the long term, the 20, 30-year play. It's not the 5-year play. Because I personally think Tesla's going to dump off that price point and have to work their way back up. But I think it's going to be data mapping and them furnishing that data to companies, which can create a licensing royalty forever. And then as you get more Teslas on the road to get more data, not just in the United States. And that's one of the reasons why Elon Musk was telling the Chinese that I'm not going to take data from China and give it to the US, because he realized that the Chinese know that Tesla cars are accumulating data all the time. And he had to make them very confident that he wasn't going to do that, else they would have probably kicked him out of the country. But I think that's going to be the play, because eventually we're going to go into a space to where you're going to get into the car and the car is going to just drive you to where you need to go. And it's going to know where it needs to go because it's already mapped the road out. And that's really what's going to change everything, because most accidents on the road are driver error. They're not mechanical error, right? Most accidents on the road are because the driver makes a mistake, not because the actual machine fails. Cars are relatively safe. It's people that are unsafe. People are really unsafe. Like, you got to be careful. People will get you killed quicker than anything else in the world. So as people on the road are unsafe, if we can get people away from driving and just let computers drive, the roads will become incredibly safe. Incredibly safe. And then you can drink how you want to drink and just get into a car and just let the car drive you home. As long as you can get out of the car and get into your house, you're good. But we see with the guy play for the Las Vegas Raiders, he got into the car drunk, drove at a high rate of speed, put himself at risk, killed another woman, and also put another woman at risk to die, and really risked everybody on that road. That's human error. That got nothing to do with the car, because the car don't go 120 until you make it do it. So we can eliminate that. So Tesla, to me, that's their real value, but it's going to take years to get to that stage. And so to me, if you're investing in them, you got to be willing to just play the long game, right? And Elon Musk, he may not even be CEO when they finally do that. But to me, that's the long game. If you watch iRobot, they do that, where Will Smith just gets into the car, and it's almost like driving down a train track. It just drives you anywhere you need to go. That's what we need to do. That's one of the reasons why planes are so safe, because the human does very little flying. They do the takeoff. The takeoff and the landing are computer assisted. Once you hit altitude, it's cruise control, and you're on a flight path. That's what made flying so safe. And it's rare that a plane crashes. Why? Because we've taken humans pretty much out of it. They do help assist it on the landing and on the takeoff, but computers are doing the rest, and computers are going to be doing more and more as time goes on. And that's one of the reasons why planes are so safe, right? The roads are dangerous, and I know because I drive a lot. These roads are crazy. Ain't no telling what's going to happen out here. Yeah, it's the same investment, because Ontario Getty, the amount of money that you start with has very little to do with your ability to trade successfully. It's you. So that's why in the VIP course, we incorporate the mindset counseling that I encourage you to take. It's very beneficial, because most of us have been failing at getting to where we want to get in life because of us. Got very little to do with the course or the education or the curriculum, anything. So once we start dealing with ourselves and we understand what challenges that we got going on, we can defeat that, because getting rich or becoming successful in anything is a process. So if I tell you put 500 in the account and in 6 months, you can be at 5 grand or 10 grand, that's a process. But most of us ain't willing to deal with processes, which is a psychological issue because everything in the world is about a process. Nothing happens overnight. There's a brother I know that does credit repair. He'll tell you, I can repair your credit and eliminate your derogatory credit and put you in a position to where you can get loans. But it might take you a year. Most people don't want to take a year. So they buy into a scammer and they do whatever they do and really mess your credit up. Because he's telling you out of the gate, it's going to take me a year to get your credit right. Because we got to do this, we got to do this. It's a process. Most of us don't believe in processes. We want things to happen like that when we want it. And the world don't work like that. So when you look at these markets, Amazon was a process. Apple was a process. These are processes. It's a way in which you got to work your way consistently towards this goal, and you just got to keep doing it. So you can start with the 250 to 500, and you just got to commit to the process. Because a year from now, you'll be in a much better position if you just stick with the process and you don't leave the market. Because there's so much money in this market, you'll find it out that I can just pull money out of this market when I want to, but I got to commit to the process of making myself into a trader. And that's really what we're trying to do, is get people to realize that life as a trader is way more beneficial to them based on how they want to live. And they just got to be willing to commit to the process. The same way if you want to get in shape, you got to commit to the process. If you want to graduate from college, you got to commit to the process. If you want to get promoted in the military, you got to commit to the process. Everything's about process. And we got to start investing in these type of things as opposed to thinking that I'm going to get it in 90 days or else it don't work. So we got any questions before we bounce up out of here? We at 1:16. What time is it? 7:29. But I would tell you to get into that VIP before we move that price up, because once I drop the short sellers course, the price going up. Because that's probably $1,000 course within itself. I feel you. Yep. When I was in college, I just ran the whole thing straight through. I did that because I was trying to get out of there. I ran that. It took me 6 years to get a bachelor's degree because I was working full time, but I just ran it straight through. It was one. See, this is what happened to me, Katrina. I took a summer off one time, and when I came back to school, it took me so long to get back in the routine of studying. I said I can't do that again, because one summer I needed to make some bread, so I just took the whole summer off and just worked. And it literally took me from August to maybe mid-October to get back in the routine of studying all the time. I said, I can't do this again, because once I get out of my routine, it takes me so long to get back up to momentum, because I had momentum. So then from there, I just stayed in school the whole time. Then went to university and just stayed at it. But I didn't take any breaks. And I took, I think I graduated community college like almost 70 credit hours. I just took so many classes. It was crazy. I would recommend the VIP course, and I would tell you to invest in yourself, because if you want to pull a certain amount of money out of the market, you got to be willing to pay the investment and to pay the tuition, and then tell you to commit to the process and commit to yourself and not look for something to come with no investment. Right. So I'm going to help you become successful, but you got to commit to it, because if we can get you to a certain point, you'll look down the road and realize that essentially the curriculum was given to you, as opposed to like what a college is charging you, where they charge you $30,000, $40,000 to teach you how to be a lifetime employee. So I would recommend the VIP course and just commit to the process and not look for a 30-day turnaround. You can't turn yourself into a trader in 30 days. It just don't work that way. Just like you can't get in shape in 30 days either. Yeah, I worked the whole way through. So I worked full time and went to school. I think most of the time I took 3 credit hours, but I worked 40 hours a week because I had to work. So I worked full time and went to school, but I started off taking like 1 class, then 2 classes, then worked up to 3 classes. And so because I was taking sometimes 1 class or 2 classes, I just took throughout the whole year, because I had to make up for the fact that I wasn't taking a full load. But I mean, it was rough, but I just stuck with it. Because one thing about me is if I make my mind up, I'm gonna do something, I'm gonna do it. Looking back now, I wouldn't have went to school, but I didn't know any better at that particular time because I was so programmed by the system. Knowing what I know now, I would have just went and got me probably like a real estate mentor and just learn real estate. But I didn't know what I know now. So, you know, everything happens for a reason. But college did teach me a lot, especially like my accounting classes and my economics degree. But it just was a lot of time and a lot of money because I was paying out of pocket. I didn't even have financial aid. So we got any questions before I get up on out of here? And I appreciate everybody coming through. And Urban Homestead, man, I'm glad you're doing well. Okay. So it looks like that's going to be a wrap. So I appreciate everybody coming out, giving me your time. I want to tell you to just stay focused on the markets. You know, cut out the chatter, cut out the distractions. Keep doing what you got to do. I'll be back on Saturday with the weekend markets and also like a particular topic that we're going to break down. If you got any questions, reach out to me. The link's going to be on a particular video. The live stream will be up and we keep it pushing. Urban Homesteader, I appreciate y'all, man, because I appreciate you for giving me the support because that's what, you know, allow you to keep pushing. You know what I'm saying? So I appreciate y'all coming through, doing business with me. With the most important thing to make sure I'm valuable as a business person. And, you know, everybody just continuing to support and we're just going to continue to keep building out. It ain't going to be big, but, you know, we can get a small group of people that's committed. You can do anything you want to do in the world. History has shown us that, proven that to us in history. And my goal is not to have a mass movement, but to just drop certain people off and let them do what they do. And that's how we're going to change everything. It ain't to change everybody. It's just to drop certain people off in certain spaces and just let them do what they do. Like I said, I come from a different environment. I know you don't need a whole lot of people to change nothing. You need a small amount of people that's really about what they're about. And so we've been able to produce people out of this space that's really serious about what they're doing. And they changing everything. And not only changing everything for themselves, they changing everything for their family, which is the most important part. So they descendants are raised with a different perspective of how the world works, right? And that's what changes everything. And it don't take a lot of people to do it. They just take a small amount of people to do it. And that's what changes everything. I keep telling people, Communist Party in China is 10% of the population. They dominate that whole scenario. And they also are world power. And it's not the majority of the Chinese people because they understood it don't take all of us to do it. Take a small amount of us to just be very committed to what we're doing. And as long as you keep going, you'll change it. So I appreciate everybody coming through. It's David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the World Options Trading Academy. Y'all be safe out there.